Okay, here's a riddle for you. How can a company sell less of its product but end up making more money? I mean, sounds like it breaks the laws of business, right? Well, that's exactly the puzzle we're digging into today with a company called Hoe Leong Corporation.
It really does sound impossible, Alex. And it's these kinds of weird, counterintuitive results that make really smart investors lean in and pay attention. So today, we're going to put on our detective hats and run a little financial investigation to figure out how on earth Hoe Leong pulled this off.
And here are the numbers that really set the stage for this mystery. If you look at their full year results for 2025, their total revenue, that's all the cash coming in the door from sales, it actually dropped by over 12%. But, and this is the wild part, their profit before tax shot up by a massive 26.5%. So less money came in, but more profit was left over. Then where do we even start?
Well, you always start by looking at the other side of the coin. If revenue is what a company makes, the very first clue is always hidden in what it spends. And from the looks of it, Hoe Leong just gave a masterclass in how to control your costs.
Exactly. And check this out. This is the big one. Their cost of sales, which is basically what they pay for the parts they sell, they cut that by almost 15%. Now, here's the key. That cut is way deeper than their 12.4% drop in sales. That means for every single thing they sold, they were keeping a bigger slice of the profit. And they didn't just stop there. They also took a knife to their administrative expenses. That's all the day-to-day stuff like salaries, rents, office supplies. They shaved off a really solid 9.5% there, which shows this wasn't just a one-off thing. They were focused on efficiency across the board. And the last piece of this cost-cutting puzzle is a 10.2% drop in their finance costs. Ben, this feels like it's more important than just saving a few bucks on paper clips, right?
Oh, absolutely, Alex. This one is huge. Finance costs are basically the interest payments a company makes on its loans. Slashing these costs is a powerful signal that the company is getting its finances in order, making the whole business healthier and way less risky for investors.
So to wrap up this first part, it's actually pretty simple. The number one reason their profits went up is because their spending went down even faster than their sales did. They tightened their belts so much that it completely made up for having less money come in. But believe it or not, that's only clue number one. That's right. Because if we only look at the big company-wide numbers, we're going to miss the real story. To really get what's going on, we need to pop the hood and look at the two very different businesses that are running inside Hoe Leong. Yeah, it's super important to get this distinction. So on one side, you've got their design and manufacture division. This is them making their own parts with their own brand names on them. Then on the other side, you have trading and distribution, where they're basically just buying parts from other companies and selling them on. Two totally different business models. In this chart, this is where the story gets really wild. Just look at how the performance of these two divisions completely flipped on its head. In 2024, the manufacturing side was the star player, bringing in over $1 million in profit. A year later, in 2025, that collapsed to just $440,000. But at the exact same time, the trading business went from a pretty good $521,000 in profit to an unbelievable $1.8 million. It is a total 180. I mean, the trading division's profit didn't just inch up, it more than tripled. This explosive growth basically became the company's new engine. It was so strong that it single-handedly carried the company's results and honestly hid the fact that their traditional manufacturing business was in some serious trouble. This is probably the biggest piece of the puzzle right here. Okay, so we figured out how they juiced their profits. But a good investor always asks the next question. Is the company itself actually stable? Is the foundation solid? And for that, we have to turn to the balance sheet. Right. The easiest way to think about a balance sheet is like a company's annual checkup at the doctor. It's a snapshot in time that gives you a really clear picture of its overall health by simply weighing everything it owns against everything it owes.
And when you're checking a company's health, one of the most important vital signs is its debt. In 2025, Hoe Leong paid down its total loans and borrowings by more than $2 million. Now, for a company this size, that is a huge step towards having a much stronger financial foundation.
And this is just so critical for an investor to see. When a company pays down its debt, it becomes stronger, more resilient. There's just less risk involved, which is exactly what you want to see when you know their overall sales are actually shrinking. You might remember those lower finance costs we talked about earlier? Well, this is why they went down. It's all connected. All right, we have one final test for our investigation. Profit is one thing, but is it just a number on a spreadsheet or is it turning into actual, real cash in the bank? To find out, we've got to follow the money and look at the cash flow statement. And the numbers here are just wow. They're really strong. In 2024, the company's main business operations generated about $1.6 million in cash. Fast forward to 2025, and that number just exploded to almost $4.6 million. This right here is the ultimate proof. This confirms that the profit we've been talking about is high quality. It's not some accounting trick or an illusion on a page. It represents a real, tangible, massive increase in the hard cash flowing into the business. For an investor, seeing this is a huge green flag. All right, so our investigation is over. We've gathered all the clues. So Ben, let's put it all together. What's the final takeaway for someone looking at Hoe Leong Corporation as a potential investment? Let's lay it out in that classic investor framework, the bull case versus the bear case. So the bull case, that's the optimistic view, all the good stuff. We've got amazing cost control and that absolutely explosive growth in their trading division.
For sure. And don't forget, they've seriously cut their debt and are now generating a ton more actual cash.
Those are all signs of a really well-run, healthy operation.
Okay, but then you've got the bear case, the pessimistic side, the reasons to be nervous. And the big one is that their overall sales are still going down.
And that's a real issue because their original core manufacturing business is getting weaker. Look, a company can't just cut costs forever to grow. At some point, you have to actually sell more stuff. And really, that leaves us with the one big question for any investor looking at this company. The entire future of Hoe Leong now seems to ride on this one thing. Can this red-hot trading division keep up its incredible growth? And is that growth going to be enough to not just fill the hole, but actually overcome the decline of the business this company was built on? The answer to that is going to decide everything. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.